So we have 3 more minutes. So the people can join the show now. From now, yeah, they can join the show now. Just let's wait. So how are things otherwise in Serbia, Alex, at the moment?
Pardon?
How are things going on there?
Yeah, we are watching like you probably what is going to happen with tariffs and with all other things. So yeah, I told you we are a small country, can't influence anything, and we are just watching, and waiting to what is going to happen.
Quite relevant to what we are going to speak today, the uncertainty and the long-term investment.
Yeah, definitely. But it's not easy to see the future. When the future is has so many faces at the moment, and it's really, and the situation is changing day to day. It's changing the policy, for example, American, and then you don't know really what is. It's difficult to make long-term decisions. However, I think the choices, strategic choices, must be made flexible in advance, to sustain significant shifts in the environment in the future. So the strategy must be dynamic. I wrote one article about that. Abdul has read it. So if you like, Abdul can give you the link. It's
Yeah,
just
sure, sure. Good,
latest, but that's how I see it.
great. Yeah, I think it's time now. It's at 3:30. Yeah, let's start. Good morning, good afternoon, and good evening, ladies and gentlemen. Welcome to Global Strategy Talk Show. The topic for today's session is aligning capital expenditure budget to the strategy. I think it's very interesting, and also it's intriguing topic for anybody in the organization, especially the leadership who wants to invest in the expenditure things. And also it's a very uh, important decision for the leadership team because it's involved a lot of dollars to spend, and it's very important. Okay, so how to do and what are the key takeaways we will discuss with the expert panel today. So let us do the introductory session, introductions. So let me introduce Mr. Alex. Uh, Alex Milovanovic. Yeah, he's a management practitioner, strategy advisor, author from Serbia. So Alex is a seasoned consultant and leader with over 30 years of experience across industries and geographies. His passion for strategy management led him to author Strategic Management in 21st Century, a book which is very widely accepted and popular. And it's a practical guide for building winning strategies in today's dynamic mindset. Okay. So welcome, Alex, to the show. We'll be definitely hearing something good from you today. Okay.
Good day, and
So
thank you very much for inviting me.
yeah. So let me invite Mr. Sandeep Cardoza, the Chief Financial Officer from Dutco Tenant LLC Dubai. Sandeep is an analytically minded business professional with contemporary expertise in strategy formulation, process management, cash management, digital transformation, and compliance. So, here Sandeep has all the things what a CFO, modern CFO needs. So he is skilled in interpersonal communication, building productive teams, developing strong customer and vendor relations, and effectively collaborating with associates to all levels of employment. That's very interesting. Welcome, Sandeep, to the show.
Thank you, Mr. Abdul.
So let me give a quick introduction about myself. I'm Sheikh Abdul Khader, CEO of Fru Strategy. So we do a strategy solution for the organizations. So complete automation of strategy management process. Khalid is waiting, so please share the link, Deep. Yeah, to his WhatsApp. Okay. So so we and part of we also do consulting for to help organizations to achieve strategy. Okay, so today's talk show will be based on the capital expenditures. I would like to tell something about briefly about Furu strategy about the talk show. So we conduct the talk shows continuously, continuously every alternate week or once in a month to connect best in industry experts to the organizations who needs help. So Deep, Khalid is asking, okay. So please can you share the link to join? Yeah. Mhm. So let me share him the link. 1 second. Okay. So another panelist is about to join. Just let us take half a minute. One second, sir. Okay. So Deep, if you are able to hear me, please connect Khalid. I shared the links to him. Yeah, he must be joining. Okay. Sorry for the inconvenience. Our another guest panelist is joining. Okay. So, yeah. Okay. So we'll continue. He's going to join. So today, what we are going to do is we are talking about capital expenditure budgets, and I ask Alex to start the discussion. So before discussion, to introduce how the capital expenditure is important from the strategy point of view, and how to identify the critical capex items, and then what we need to do with that. I think Alex will help us to do that. So what is the main part from my side is to execute your strategies. Capital expenditure investments are mandatory. Without that, it is not going to happen. Okay. So it has to be selected properly. You need to identify them, and then you have to budget properly, execute them in a sequence, and then get the results. Finally, you make sure that these capital expenditure items are delivering the value. So this is a sequence. So before Alex, before you join, I would like to introduce Khalid because Khalid Saab is a little late. Khalid Saab, welcome to the show. If you are able to hear us, you are able to hear us, right?
Yes, I'm able to hear you.
Yeah. So a very quick introduction from Khalid sir is Mr. Khalid Noor. He is a managing consultant from Univision Consulting Private Limited. So he's a senior finance leader with roles in finance, HR strategy, organizational development, culture and transformation, corporate management in global pharmaceuticals company Novartis. So he spent extensive time as a CFO there, and local pharmaceutical companies, okay, Mactor International Limited and global MNC FMCG Unilever. So he's a seasoned financial expert, globally known. Khalid Saab, welcome to the show. We just started introduction. Okay, so just you can just say a couple of words, then yeah, we'll start with our discussion today. Yeah,
Can you hear me,
yeah, we can hear you.
Abdul Qadir sir?
Yeah.
Right.
Okay, sir. So shall we continue? Yeah.
Yes, please.
Okay, can you load
Okay, Alex. Yeah.
the
So
first slide? Yeah, load the slides. Great. Yes. Okay. Okay. So we must start always with strategy. Developing strategy is about making informed choices about own future activity. And one of those choices is actually whether to have capex or not. So capex, that choice, that decision is born within the strategy development process. And to do the process well, as I said, it has to be informed. So this is why one must start with understanding the internal and external context, your customers, markets, competitors, and all the rest that matters. So why strategic alignment matters? Why you actually shouldn't do capex outside of your strategy? Strategic clarity drives effective capital allocation, and strategic alignment ensures that capex decisions support long-term business objectives. Imagine that you want to capture certain market and suddenly you decide capex to invest in something else, not in that market, something totally different. So that wouldn't be a lie. That would be a waste of money that you could spend on delivering your strategic goals. Strategic alignment ensures investment fuel the right capabilities, those that you decided to develop, and the market positioning those markets that you decided to capture, not some other markets or whatever, leading to sustainable competitive advantage. I prepared a couple of examples. So let's consider Tata Power, that is a famous Indian company. Their shift to solar involved target market analysis, strategic repositionings, and then capex. I repeat, and then capex to solar parks. So their move was aligned with not only with their long-term cost reduction strategy, but also with national green goals. So their strategy drove that decision to make that capex. And as I said, misaligned capex waste resources, allow inefficiencies, and lead to missed opportunities because the money you spend on some non-aligned capex that is outside your strategy, you don't have that money, and you don't have that money that you need to invest in something that actually aligns with your strategy. So typical challenges, I also thought about that, was a lack of clear, measurable strategic goals. As soon as your strategy doesn't have clear and measurable goals, how can you measure and how can you align first your capex decision and your capital investment, and how can you measure it? How can you know whether it was good, it is good, whether it's delivering value and helping your strategy to materialize, or doing something completely outside your strategy? So sometimes silo decision making, when capital budgeting operates independently of strategic formulation, that can happen in multi-divisional companies. When I witnessed that, when divisional leaders are actually so powerful that they can drive their own capex decision that actually are sometimes misaligned with the corporate strategy. So that can happen. You must take care of that. A short-term focus sometimes overshadow long-term strategic imperatives. So, okay, that is, let's spend money to fix this current problem. Again, maybe that money will fix your current problem, but you won't have money to actually fix your long-term direction. Then inadequate understanding of the external landscape and competitive dynamics. I started with that. You must make informed decisions. If your information is wrong, and your conclusions, your decisions will probably be wrong. And difficulty in quantifying strategic value of potential investments also can create problems. Let's move to next slide, please. Right. Okay. So how to do it actually? We must integrate capex into strategizing process, and then when you develop strategy, capex decision, that activity must be part of your strategic plans. So understanding first, again, I repeat, understanding industry trends and competitive landscape is a paramount. You can't devote your money, who knows, $1 billion or whatever, if you don't understand the context you are operating in. So that will be probably a waste of money. Then you have to ensure your capex investment cater to market needs, your customers. Again, the business must be aligned with customer needs. If you are not that, if you are doing that for someone else, then your capex is also going to wander around and be unaligned, not aligned. The best way is to use strategic goals as filters for capex decision. Another example from India, I hope I will say it right. It's a Reliance Jio company. Abdullah, my pronunciation, is it okay? Reliance.
Yeah.
So I found their massive capex in building a nationwide 4G network was directly aligned with their strategic goal of becoming a dominant digital provider. So this strategic foresight from their management, informed by market analysis first and their capabilities, so lack of capabilities before that capex, transformed actually the Indian telecom landscape. So how to prioritize capex? I say, and you will hear after me, other speakers will tell you that, by strategic value. Evaluate projects, each capex project based on their contribution to achieving your defined strategic goals. So that's first, you want to achieve certain goal, and for achieving that certain goal, you have to, for example, buy a new or build a new plant. And That's it. Or build a nationwide 4G network to achieve the certain goal, as we heard already. Link each CapEx item to a step in the strategy map. That is very important for good control of your strategy execution, what is Abdul probably going to tell you more later. You must make, you must differ if the project has high strategic value, it aligns with core differentiators, really making your company strategically stronger. For example, Saudi Aramco oil to chemicals move, or low strategic value. There are sometimes projects that are necessary, CapEx that are necessary as well. You can decide to defer or to outsource that. For example, Nigerian banks outsourcing IT infrastructure. So you can decide that too. Outsource, don't do CapEx. So you have to think carefully and thoroughly about whether to make or not CapEx, but always during the strategy development process, not outside of it. And you must, because we just discussed before this meeting started, today's environment is so dynamic, so uncertain, it's changing on a daily basis. So your CapEx probably and should be agile as your strategy. Use continuous refinement to update CapEx plans as strategy evolves, and stage large projects with go, no-go checkpoints tied to market signals. Having a modular, you will hear later, modular approach is also very good. For example, Aramco, it's a Saudi Arabian company. Long-term CapEx, they actually have an agile approach. So their long-term CapEx in refining and petrochemicals aligned with shift from oil exports to value-added downstream. So their agile response is seen in parallel digital infrastructure investments. They diversified, but with kind of agile and module type investments. You actually like a trial. You have make a smaller CapEx, smaller projects, see how it works, learn from it, and then invest more money and go to another step. Next slide, please. Okay. And I'll close this with some practical advice for leaders that are actually decision makers. Build CapEx governance around strategic goals. I must repeat that, not departmental budgets. What actually I witness sometimes happen, Yes, every department must, and big division must have, or business unit must have own a budget and will have CapEx expenditure, definitely. But that must be aligned with corporate strategy. They can't run out of corporate direction. Think long-term capabilities, resilience, everything, but allow short-term course corrections, especially today in this so dynamic environment. Use strategy formulation as a filter, not a retrospective justification for CapEx. So, as I said, draw your strategy, define your strategic objectives, and then use CapEx to push to make those objectives materialize. CapEx should be a result, not the input of strategy thinking. Start with why and with impact. So I find another examples, Dangote Group from Nigeria. It's actually a cement plant company. and their expansion followed clear market strategy, proximity. They wanted proximity to demand to move their production facilities, control of supply chain, and to achieve regional dominance. So their strategic foresight drove early capex decision. So for their plant expansions. Consider modular investments. I already mentioned that allow for scalability and adjustment. I found another company. Think about Etisalat. It's from UAE. Their strategic diversification into digital services and cloud computing requires significant capex. By aligning these investments with their strategic goal of becoming a leading digital enabler in the region, they demonstrate in the long-term vision while adopting the changing market, adopting to changing market demands. Their phased approach, that's how they've done it, likely allowed for flexibility. And then final advice, prioritize investments that create optionality and flexibility in responding to future uncertainty. So balance that with that value decisions based on capex value. So Abdul, that's it for me for
Yeah.
the time being. I hope a good introduction.
Fantastic. Good introduction, Alex. You set the tone
Thank
now.
you.
I like the idea of capex is the output, not the input. Okay, so the capex is the output of strategy. Fantastic. Now let us take one step back. Now I will ask Sandeep, maybe Khalid sir will talk about the next topic. Sandeep ji, so how to differentiate between capex, opex, and even the strategic expenditure? So let us go to the basics first, because Sandeep and Khalid are CFOs. So let us hear from them. Let us understand very basic meaning of those topics, and then uh, what is it your expectation as a financial heads about the capex proposals you receive to start with? Okay, from there we will take the deep dive on the each step.
Yeah, sure.
Yeah,
So,
Sandeep ji.
I mean, thanks, Alex, for setting the stage. Probably we'll not go through the
Pleasure.
points, repeating our points there. So, while capex is seen as a financial decision, my belief and my understanding is that it is more of a signal to the markets, signal to the competitors, and to the employees where the company is heading towards, right? So while as CFOs, we might be evaluating projects uh, only from the lens of saying that what is the cost of procurement, or what is the investment we are supposed to do, or how this will impact our profitability. At the same point in time, it signals the market also that where we are heading, whether it is aligned to our strategy internally. So, more importantly, developing capacity and capabilities, right? And competitiveness is more important and more ingrained with respect to the strategy of the company. So, as Alex pointed out, it is more of a value creation, and value creation cannot happen on an opportunistic basis. It has to be inbuilt into the strategy. It has to be inbuilt into the planning and the budgeting cycle of the company, which is significantly important. So if we have a silos of saying that okay, strategy is discussed in a separate room on a separate time period, and the financial budgets and plans are discussed in a separate format, then you will have these gaps in between, right? So it's a reallocation of resources from the point of view of strategic alignment would be very more important, right? And especially I think so Alex brought a very good point about departmental budget, right? So every departmental or functional head will have a pet project, right? Or would want to invest or want to create or demonstrate value, right? Whether that demonstration of value happens through strategic alignment, or whether it is the season or the trend which happens, right? Especially, I mean, what we are experiencing right now, right? Every so for example, in a distribution business, right, where I come from, uh, there is a significant importance of digital transformation. And with regards to digital transformation, they are long-term projects. You cannot just fix things in silos, right? It will not align you as a whole. And we have seen so many times that managers will come saying that, okay, let's buy a procurement system, or let's buy a supply chain system, or let's buy something in finance to do the AP transactions, right? While these decisions, if they are made in isolation to the overall efficiency which needs to be created, you will not see the results, right? So that's one of the important thing, and having a clear criteria which only a strategy can provide, right? Why are we doing it? I think so. Alex also put it in his presentation. Why? What is the reason? Start with the why, and then the how, and where you will invest in. He did talk about the green capex, which is the current trend, right? What we see in our distribution business also is that many investments are going in IoT devices. People want to measure efficiency of the current plant. They want to extend the economic life of their current plants, right? So the distribution line and the transmission lines for the electricity, we have customers who want to see how they can improve the efficiency of the existing transformer, right? And see like it as an alternative to making a capex spend, where especially in energy generation, you have a significant infrastructure to be built before it can be utilized as a whole. So these are the few things, and probably I will leave for a few more questions
Yeah.
to add more points. Yeah. Thanks.
Yeah, Sandeep, you talk one very important point. You said capex is linked to a market, or maybe it is connected to market dynamics, and also capex influence people, employees. Okay, how does that? Okay, market. Yes, I understand the business
Correct.
development and everything. Market. How
Yeah.
does that employees feel about the
Yeah.
capital
So
expenditures?
I have a
This is
personal
something
experience about that,
different.
right? So,
Yeah, yeah. I would like to
the
hear.
reason I recently mentioned is actually just 2 months ago. Actually, we opened our own warehouse distribution center along with the the office space in it. So we integrated our warehouse and office space. It was just recently happened, just a couple of months back. And what we experienced was, the sheer pride and the joy for all the employees,
Mm.
right, within the organization, and a sort of it pitched us as a space within the uh, in the map of Dubai, actually, so to speak, right, where we have an integrated. So we always had our warehouse, we always had our offices, but they were never integrated together, right? So when what employees are now seeing is that within the organization itself, right, that you have a symbol of a physical presence, right? So that's one of the examples what I see. But I'm sure
Mhm.
there are other panelists also would agree that
Mm.
uh, most of the
Excellent.
whenever an infrastructure is built or seen, it attracts, that it creates an attraction for both the current employees as well as your prospective candidates
Prospects.
to come and
Mm.
enroll with the organization.
Fantastic point. Fantastic. I think it's very interesting. Yes, capital investments definitely give some kind of satisfaction to the employees. It gives them immense stability, and then the future. Yeah. So seeing is believing. Come, let's hear from Khalid sir. Khalid sir, you have experienced in capital expenditures over maybe 3 decades, maybe 4 decades. Okay, so let us say a scenario. So you have budgetary constraints. You very rarely CFO is say that I have enough budget. So yeah, it's always challenge. And at the same time, you have the requirement for the business from the strategy.
Right.
So how do you do that? Typical CFO, how do you balance the budgets and then the strategy expectations of the
Sure.
capex? How do you have a trade off? Yeah.
Thank you, Sheikh Sab. And thank you, Alex and Sandeep, for a great start to the panel discussion. I think Alex covered most of the points. So it is very interesting. So all the capital allocation, yeah, you're right that there is a limited amount of capital which is available. So it all depends on the company's strategy. I will give you a few examples, and then it will make it more easy to understand. And for example, in Pakistan, the weather is quite warm. Unilever acquired ice cream business. I'm so sorry. I have to take this call. So sorry. हेलो जी हमजा बात करें जी हमजा बताइए
You're in mute, huh? Khalid Sab, you're in mute. Can you unmute Khalid Sab?
So sorry for.
Yeah,
Yes, can you hear me now?
yeah.
Right. So I was talking about the capex decision is all aligned with the business strategy, corporate strategy. So I was talking about Pakistan having a very hot weather. When Unilever decided to acquire the ice cream business, they thought that it would be great to invest an ice cream business into Pakistan. But guess what? There were already strong players in the market who were dominating the market. Um, so first, they offered to buy out a local company, the market leader, and they had a lot of difficulty in acquiring that. They paid a very high price, but once they acquired it, then they saw that it doesn't meet their quality standards. So, so they had
Mhm.
to uh, manufacture. They had to start with a greenfield. Um, but what they were able to do is to kill the competition, and then when the new factory started, so it was a huge investment, because you need to set up a cold chain, you need to set up the distributor who can manage the cold chain. So and it was a new area. But with the acquisition, what happened that you were able to bring in the know-how and technology. So people who were already familiar with the ice cream. So when we talk about capex, it's not just hardware; it is actually the knowledge, the customer list, for example. Or so that's where the M&A comes in, mergers and acquisition. That you are not just paying for the assets, and you also mentioned that intangibles. So the intangibles are actually your market share, your know-how, your systems, your processes, your people. So that's where the M&A decision valuation comes in. The capex is of two types. One is the strategic capex that we were talking about. The other is operational routine replacement. For example, the machine has got a 10-year life. After 10 years, you need to replace it so that there is an efficiency, etc. So that's the part of normal budget. And normally, uh, how we used to do it was to that within the depreciation expense amount was the capex amount. So if the depreciation amount is coming as $20 million, then we will limit the replacement capex to $20 million. But when it comes to strategic investment, that's a separate ball game. So over there, uh, the strategy comes in. So you do a long-term cash flow analysis, DCF analysis, IRR, etc. All the financials that you do. But most importantly, you look at the what are the business fundamentals, what are the key strategic priority that is going to be justifying that investment. And there you can have several projects. So the, for example, the ice cream business, the tea business, the edible oil business, or the detergent business. So there is a competition going on with all the business unit heads. So there comes finance, which is able to rank these projects based on the return on investment, payback period, IRR, etc. But most importantly, where the value is created. So in this case, they thought that uh, getting into the ice cream business is a much more value-added segment than compared to a tea business, for example. There is very little value addition, so it will give them a competitive edge. Uh, but what we see now, and it all depends on the forecast, the accuracy of the forecast. Uh, Obviously, there is some bias in the forecast. So the person who is leading the ice cream business will show a rosy picture so that the financials will come. And that's where the finance guys come in, and they try and create scenarios as to what is the best case scenario, what is the base case scenario, and what is the worst case scenario. And based on these scenarios, the capex is evaluated, and then they are ranked. A weighting is given, that okay, finance is given 50%, strategy is given like another 50%, and then you can actually decide on the which capex to go for. Uh, it is so important that the long-term strategy has to be clear, and sometimes it is not. I will give you an example that the company actually acquired, after acquiring Lipton, they acquired Brook Bond. So they had two manufacturing facilities now. So one of the factors that they needed to do is comparison as to which factory is more efficient. And it was a difficult decision. So one factory had to go for a closure, and the other factory. So that those kind of consideration needs to be taken into account. Also, one more example, from my pharmaceutical background, the Novartis was actually wanting to shut down a lot of plants across the globe, um, because quality was a major factor, and it was easier to control the quality in a smaller footprint. Large scale manufacturing as a global supply center. Um, so there, uh, a local example that one of the factories which was destined to close, um, the local management were able to convince that okay, for pharma you can close, but for OTC business, this plant has got a lot of potential. There is a big market for over-the-counter medicine. So they invested like $25 million and made it really state of the art. But then what? Novartis sold out the OTC business to GSK. so so all the work that went into, and the investment went into, and the cash flow that was supposed to be generated, the benefit moved from Novartis to GSK. So and in one more case, in another pharmaceutical company, they invested in a brand new plant in penicillin, very popular antibiotic in Pakistan. But then GSK had already dominated the scene, so that investment could not yield a return and was actually shut down. So, so the key thing is, how do you link your strategy, and how do you see future, linking to, and you have to link it to your strategy. Silo-based decision will actually waste a lot of companies' resources.
Fantastic, sir. So you said two important points. I'm not sure how these mid-sized companies and larger companies differ in that. You said if you have a large manufacturing machine or something, so you accumulate all depreciation and then finally you use that for procurement. Is they do it seriously like that, or in this volatile environment? Uh,
That sets a limit, upper limit, that okay, for routine replacement. And if you're maintaining good machine, if you're doing good maintenance, then the machine life can be extended, some parts can be exchanged, and therefore, yeah, it depends on the country growth. So if the growth and outlook is not very strong, then you will probably not invest, or you will postpone those investments. So yeah, you have
Perfect.
to look into external environment.
Yeah, perfect. I think now let's time to go to the process. How you do the strategy planning, strategy formulation, and the outcome of strategy formulation is strategy plan for three to
Yeah,
5 years, and then this strategy plan help you to drive capital expenditure plans
right.
to meet that, and then you come up with a business plan for that particular year. Okay. So in that particular year, how you do the business plan and budgeting, where capital expenditure budget and operational expenditure budget, all you do that. Let us talk about the process. Let us do that. Okay. So because I have a question
Mm.
from Samir. So how does that process take place in typical organization? What is the best practice? Yeah. Khalidji, I think
Yeah,
you can
yeah,
start
yeah,
with that,
sure.
and
Thank
then
you.
we could go to Alex and Sandeep.
Right. So we are familiar with the strategic planning process. One of the outputs of strategic planning is the identification of what capabilities are required. It will be both human as well as technical and hard and manufacturing capabilities that are required to execute that strategy. So you have to come up with what is our current capability, what are the capability gaps, and then out of those capability gaps, how much relates to capex, how much relates to opex, how much relates to the human skills that you need to acquire. That is after that process is done, it is actually validated. The leadership team, sometimes management consultants are also engaged as to assess the the skill gaps, the manufacturing or technology gap. For example, as Sandeep mentioned, these days digital investments are taking place because companies feel that they have a gap, major gap, and they need to catch up. So a lot of resources are diverted towards catching up with digital technology, making online business, making AI based processes, robotics in manufacturing. So it is the driving force is your strategy. And then the strategy gives rise to what kind of skills and gaps you need, the what kind of capabilities are required by the business, and then the technology that is required. So world is changing very, very fast these days. So technology today is obsolete tomorrow. So you have to, as Alex said, that you must, in order to mitigate that risk, you should do modular investment as opposed to full-scale large investment. So the driving force for any capex decision will have to be significant capex decision will have to be strategy based. And as you know, that strategy also is not fixed, it keeps on evolving based on so there we are.
Perfect, sir. So I just add, I would like to add one point based on my experience. So when I was doing this budgeting process, so one of the scenarios to increase the capacity of the whole supply chain of the
Right.
organization. So it started from port silos, storage, manufacturing plants, and then the logistics, the connections, and then the downstream supply chain transportation, everything, and including the management systems to support all this. So one of the most important challenge for me was to sequence them in such a way that we get the best value of these capital investments, and also make sure that we have a proper cash flow issue,
Yeah.
cash flow problem is avoided, and also it is connected to the results. Like the whole supply chain capacity is increasing in layers, so the storage, manufacturing, and then the revenue, all are synchronized. So that was a
Right.
typical challenge. If you take as each capex item, it was very decent. The manufacturing head has given a very good explanation of this. Very nice. The analysis and everything. The storage materials management guy has given very nice plan. But the thing is, the challenge was connecting all of them to generate value. So that was something which we had a plan that if anything goes wrong in the whole supply chain, either it is a demand or something, we don't want idle capacity. So
Right.
we put in a plan in such a way that we increase the capacity, but we also manage that risk of facing idle the capacity of catching up of the market. So that was something which we had done very nicely. So now let us come back to a process. So in a strategy planning process and then the business plan. So Alex, so how do you connect this to static? You already explained this. Okay. So let us connect that to capex. You select the right capex items, and then Sandeep, I would like to ask you how you evaluate that. So what is the best way to evaluate? Okay. So Alex, let us start with this. Yeah.
Okay, I will start with Khalid's talk. He said a gap. You must define is that gap in your capabilities. That's that's the major thing. You know, if you define that wrongly, then your capex will be misaligned and will target a wrong place in your organization. So back to learning, actually understanding where we are. What is our know-how? What first to understand our own capabilities. That's our know-how. How strong are our assets, production assets, or whatever business we are in, our people, their knowledge, their skills. That's in today's business. People are probably your most important and the most valuable assets, you know, especially in this knowledge industry. Then, to understand your external environment, you do the analysis, you select your generic strategy or something innovative completely. By generic strategy, I mean you will try to be a cost leader. You know, you have the advantage in lower production costs, so you attack the market based on lower prices, attack your competitors, or you differentiate. You have a product that is delivering some extra value to your customers that your competitors can't copy easily. After you decide that, you decide who are your target customers, what are you going to offer, products and services, where are you going to compete, markets, and then when you make all those choices, you define your strategic goals. So now when you know where you want to compete, with what products and services, and to which customer segments, okay, and you define goals, what do you want to achieve in all those areas, you actually defined that gap, because you remember where we started, our know-how, our current position. And now when you know where your future position should be, that's where you are aiming, you establish the gap in your capabilities, and then you can make a decision, what are those key resources I need to improve. So for example, I don't my business is not digitalized, so I have to invest in digital transformation. Let's say I was actually personally, that is true. Mid 90s, I was the plant director of a company there in Johannesburg in South Africa. So my plant, some of the plant was too old. Okay, I needed capex to invest in new plant, or additional capitalization. Actually, we sometimes invested in total refurbishments, replaced engine, gearboxes, and most of those things. And when we actually capture that as a capex investment rather than ongoing expenses, operational expenditure.
Okay.
So when you decide in what resources you need to invest, you still, as the time goes, you have to watch what is happening around and adjust those decisions accordingly. Because, as you said, as Khalid mentioned, there are examples. You invest your free cash flow somewhere that is going to be wiped out by some future decision of somebody that you are not controlling. For example, currently some other state that imposes tariffs, and then you are out. Your plant in some country is becoming unfeasible. That's it.
Yeah.
So yes, always you have to be adaptive and flexible, and try to lower the risk, to mitigate the risk of overexposure and playing everything on one card. Yes, I know. If you put everything on that, yes, it looks like the return on investment is going to be maximized. However, the risk is going up
Right.
as well. And in this very risky and very turbulent environment, I would rather be cautious. Some people won't agree with me, but that's how I
Fantastic.
am.
Great, sir.
Yeah.
I think we have a couple of questions. I take the second question first because it is relevant to the discussion. Alan Fell, our senior strategy consultant. We all know he's a global name in the strategy. So the question, Sandeep, maybe you can take it up.
Yeah.
So, what is your experience of effective capital investment appraisal? I often see this as a weak link in planning process. So, how does that capital investment appraisal process take
Yeah.
up in the typical organization? Yeah, Khalid Saab, maybe you can also brief on after Sandeep. Yeah.
So what we have, like what Alex and Khalid said, what is your starting point, right? Where does the capex fit in the overall process or planning cycle, or whether it is fitting in the strategic decision making, right? So that alignment is very more important. So the approach what internally we have taken in the company is looking at a capex as a sort of a portfolio. Whether are you doing the capex for growth, are you doing the capex for, like Khalid said maintenance or upkeep, or whether you're doing mitigating any risk or being resilient about capex, or is it a future initiative, something like AI, right? So let me start with the AI as an example, right? So most of the companies, what we are seeing now is, right, the amount of investment they have gone through, right? Buying the servers, buying the GPUs, and whatever is required for them to build those capabilities either internally within the company or as a sourcing requirement. What they have done is, actually, to begin with, there is no ROI, right? So if I wait for my ROI calculation, most of my AI expenditure would look waste, actually, right? It wouldn't generate any positive cash flow, right? So moving beyond ROI is also important in certain strategic initiatives, right? So looking at what is the customer experience going to be. Again, I'm coming back to what will the employee experience going to be, especially when it comes to the newer generation, right? People want to engage in a much more efficient manner with the systems, with the processes, when it comes to the digital side of things, right? So ROI is not necessarily clearly defined, but having said that, okay, I'm going to improve the customer experience when the customer walks in to my store, or the customer walks into my distribution center. What is the time taken for him to turn it around, the goods to turn around, or what sort of digital capabilities I have around it, what sort of experience does the customer gain, So that would be one of the way to measure it, right? And your traditional metrics, like internally what we do also is on the balance scorecard, right? Saying that, okay, how this fits into my total strategy, which is clearly indicated from the balance scorecard, and who is responsible for what. So identifying clear ownership, right? One of the, actually, most of the CEOs want AI to be the investment choice, right? So, and my CEO also naturally came to me and said that, okay, Sandeep, what are we doing about AI, and where are you, going to invest it? So before doing AI, actually, right, you want to make sure that you have a data infrastructure,
Data in structure.
right? Before doing, if you do not have a data infrastructure, if I think so, Alex pointed about people are so important. If they are not willing to move away from the current processes, right, your data literacy within the organization is poor, right? AI investment is going to be completely disaster. It's not going to be, giving you the returns what you are expecting, right? So the alignment from these aspects are quite important, I guess. I hope I addressed the question.
Perfect. Yeah, I think, yeah, let's continue this topic. Khalid Saab, maybe you can just give some thought. Okay, so for futuristic initiatives like AI, ESG initiatives, okay, the climate change initiatives, you have to do it. You cannot really calculate return on investments. But some classical investments like a capital expenditure, capacity expansions kind of thing, I think you do the typical appraisal process. Khalid Saab, a classical capacity expansion process, like how do you do the appraisal part for that? Yeah.
Right. Thank you. So a typical capacity expansion plan would, first of all, we need to engage your marketing people to understand what is the sales growth, unit growth is going to be happening. Based on that, you construct your sales plan, and you look at whether that capacity, how much capacity you need to increase. And you're not looking at current capacity, you are looking at capacity which is going to be required in 5 years' time, in 10 years' time. Uh, Basically, you're looking at an optimal capacity utilization rate that 60% plus, uh, but then it may not happen in the very first year. So you will say that in year one, the capacity utilization might be 30%, then 40%, then 50%, and then maybe in year five, it can go up to 60, 70%. So the first thing is to actually assess the market opportunity, looking at the competitors, looking at your market share ambitions, uh, and looking at the innovation required. So a full business case is made, but the starting point is your marketing estimates. And as I said, then you also look at various scenarios. What if there is a new competition comes in? What if there is a new technology comes in? So all the best case, worst case scenarios needs to be prepared. So a good financial analyst will prepare the scenarios after discussing with all the leadership team. It includes the salesperson, the marketing person, the technology person, the engineering person, because the technology required or the new technology which is coming available needs to be understood, whether we will be able to service that technology in a given geography. uh, so you can't buy the most advanced machine which may not work in a developing country, for example. So the so it is financial feasibility, business feasibility, technical feasibility. These are all required, and they are put up. So a document is prepared for approval by the board. A presentation is made whereby the finance person will give the their analysis, but essentially before even financial, the business person will actually present the business opportunity. The technical person will require what kind of technology is required and what kind of investment is required, what is the phasing of investment required, and based on these premises, the finance has prepared a DCF analysis or the net present value analysis, whereby it can say that, okay, I'm investing 100 million in time zero, 120 million next year and thereafter, and my production will start from 2 years from now. So the first revenue from the new plant will come in from in after 2 years. So those cash flows are plotted on a Excel spreadsheet, and then using the famous Excel functionality of NPV, IRR, payback period, etc. So those are already readily available. But as both Alex and Sandeep says, financials is just one parameters. The other parameters are sometimes even more important. For example, compliance. Suddenly, there is a requirement that carbon emission has to be a zero by 2030 or something like that. Then you need to invest in the plant now without regard to ROI. Then, when it comes to safety and compliance, it's a must. So, therefore, uh, the uh, business strategy investments, yes, you do the whole cycle of business case and business case presentation and board approval. But when it comes to compliance, you just inform the board that we need to comply with the new regulations, and this needs to be invested by such and such period.
Fantastic. Great, sir. In my, I just add to one point, Khalid Saab, is when you are doing a capital approvals and all, even if you are going in expansion, the completing the project, okay. So one thing what I notice is the capital expenditure, the plans, execution, everything will be done. So once the project is completed, then there is a little chaos. Okay, so you are not ready from the management part of it. Either your process you did not fix it to take care of the new capacity expansions, or your people are not ready. So there is almost always what I have seen is there is a rush. So people rush towards fixing the process, giving the trainings, and then changing the process. And there is, why don't we take up this as part of the capex itself? Okay, so uh, establishing the capacity expansion project, aligning it, all the enablers like a business process alignment, the technology integrations. So why don't you do that? I have seen so many cases. You have a very functioning production control system. You have a functioning SAP, but there is no integration. They miss the integration, and then this integration they will live for at least 3 years, 4 years, 5 years without that. So they struggle to get the funding for that. Why don't you do that as part of the capex itself? Is it the reason is like a the control system establishment is a silo thinking, and then SAP is by IT guys thinking. So why don't we do it like that? So what is your take, Alex, in this? Mhm.
Yeah. Again, if you start with a business objective, you want to achieve certain new capability, and as Khaled said, that capability something doesn't need to be primarily financial. Let's say you have a problem with the safety issue. You have too many injuries in your plant. Okay, so you are investing, and your primary objective is to reduce those injuries, so you don't measure it through the return on investment. And as well, as Sandeep said, people are the most important thing. You have to merge all those factors together, and after you decide what's the objective, and you created your capex project, you must develop the plan that will actually look and address all those key points, starting from people, technology in the company, you mentioned that, remote positions, so everything. And what Sandeep said, somebody has to be responsible. You must appoint a key responsible person for driving that project, and all those metrics. And after that, normally you transfer into your balance scorecard and strategy maps. You have your OKR system with KPIs and everything. And that person who is a project driver, must report and directly inform CEO and whole board all the time what is going on. And they must be able to intervene if that doesn't work. But if you don't address all aspects up front before you develop your action plan, how to do that, to execute that capex, it won't work because something will always surprise you. Okay, there is a too much resistance to change. Okay, but sorry, you didn't think about that there at the beginning. It surprised you 3 months later. So that's what I'm telling you. I think.
Fantastic, sir. I think,
Uh,
Samir, you
I have
asked
a I
one
have a point to
question.
make here.
Yeah, yeah, please go ahead.
Somewhere I was reading actually, before doing it fast, before climbing a mountain fast, make sure you're climbing the right mountain, right?
Correct.
So, I mean, this is typical. I have experienced it so many times in so many projects that while the teams are dedicated, while we have the ownership clearly defined, while we have our objectives clearly defined, you will have aspects that you will miss, right? And that is just the nature of things happening, right? But if you are, as I said, if you are climbing the right mountain and if you can pick up the pace, you should be able to get there, right? So what I've typically done is, especially in terms of finance planning, right? You don't want to be plan in a manner that everything is going to go based on the plan, right? You have to have a sort of a buffer in your project, and that has to be clearly communicated also, that you do not build a buffer across each
Buffer,
function,
yeah.
but you build a
Yeah,
buffer across the project, right? So nor that the IT manager is going to say that I am going to get delayed, and the functional manager is going to say that I am going to get delayed further. So not everybody is building their own buffers, but on an overall basis, you want to from the strategic point of view, you want to make sure that you build a buffer around these times, and set a realistic expectation to certain extent. It doesn't compromise the overall objective of the project, but it still make sure that your teams are coming victorious, and they say, oh, we missed this, but we have some room there,
fantastic.
and then we can go ahead and do it. Yeah.
This is like a theory of constraint in project
Yeah.
management. So you don't build buffer in each task in activity. So you build buffer on the as a project as a whole. That's fantastic. I think one relevant question to our discussion from Samir is, so cost of change management. So when you are establishing a capital expenditure, capacity expenditure, or any capex items, cost of change, there is a tremendous change management is required. So cost of change management, should it be part of the capex itself, or is it like a separate initiative? So this is almost always overlooked. Okay. So what do you think, Khalid Saab?
Right.
Please. Yeah.
No, you're absolutely right. This is one of the most important success factor, change management, and it is very often overlooked. So it depends. So the best practice is that you should create a project team consisting of all the key functions. First of all, that it has to be a great communication plan, that why we are doing such a thing, and what are the key requirement of the new investment. So, for example, if it is a project which involves a lot of safety compliance is required in that project, then safety training needs to be given across the company. Everyone has to be given a safety training. So sometimes it's cultural, sometimes it's mindset, sometimes it's actually skill given. But the change management is essentially a two-way communication between the top management telling as to why they are doing it and what is actually required. So, hello. Um, so, and there the role of HR comes in a great deal, and also the senior leadership team. And they can, when you are having a quarterly town hall, or you are having a one focus meeting groups with the key leaders in the organization, it is you need to really tell them as to what kind of change behavior is required. So if the customer, so if you are going digital, that doesn't mean that the customer service personal touch goes down. Digital means that it's an additional service to the customer in terms of speed and reliability. So those are kind of things that uh, that the organization should think, that what is the impact of any major investment which is going to change the way they are working.
Fantastic, sir. Yeah, fantastic. Okay, so let us take up another question from Samir. He asked earlier. Now we will do is in the next 5 minutes we talk about the process, then we talk about another 5 maybe 10 minutes maximum about how the capex progress can be reported and then reviewed. Okay, so as part of the process, Samir's question is. Uh, Practical approach of identifying, classifying, differentiate the capex and opex statics, when, where, and how we can use these during the business planning and annual budgeting cycle. So he's asking just like a capex and opex and statics, how to define them, and then how to introduce this in a overall business planning and budgeting process, which is the annual cycle. Okay, so would you like to take it up, Sandeep, hmm for
Yeah,
this?
sure. So, like, most of the capex would be beyond a 12-month period, right? So, uh, not necessarily everything will fit into your budgeting cycle per se, right? But yeah, budgeting on an annual budget would be a period where you will consider most of the items, right? So, generally, typically, what happens in an organization is, I mean, I can give example of ourselves, is that during the October, so we follow 12-month period, Jan to December as the closing for the year, and during the September October time, where you will evaluate the period gone by, right? And that's where you understand, saying that, okay, what are we doing, and how are we looking to close this year? How are we going to evaluate our current thought process, or are there any strategic initiatives which we need to now invest, right? So what we do is we combine these two together. We don't do it a separate strategic planning and a separate budgeting. So there has to be sort of an interlink between these two. So to address the question, when, right, it has to happen together as a strategic planning and budgeting exercise as a combined feature. And how we can do it is mainly, so what we have typically followed is, in terms of measurement, is keeping it things simple, actually, in terms of having a consistency in terms of balance scorecard, right, where we can measure our strategic initiatives as well as the operational growth and initiatives and how they move forward. So that would be my comment there.
Sorry. Yeah. So I hope this is like a very quick answer to Samir. Khalid, when you keep on executing capex, so there is a scheduled payments. Like, so completing schedules by schedule is very important because of you need to manage your cash flows. Okay, that's very critical. If there is any projects don't go as per the plan, you have a big cash flow problems, right? Because you need to pay for
Right.
capex. Okay, so how you monitor the progress of capex, how you make sure that everybody knows in the organization, okay, and then how you force them to just follow the plan of capital expenditures, because there
Right.
could be interconnected deliveries for each capex projects. So can you give us the how
Then
the organization typically work from the best practices point of view? Yeah.
Right. So first of all, the entire capex is managed by a project management team. They follow the uh, typical Gantt chart and network, and they see when is the next based on the work in progress. And what kind of payment schedules are coming. So the technical department and the finance department works very closely to come up with the cash flow, and it is monitored monthly by the senior leadership team when they're doing monthly business review meeting. Capex is one of the items, and it shows how much we have spent to date, how much is coming in the next 3 months, and also the treasury manager is very well aware, and he is kind of ensures that uh, the for project financing lines are separate from working capital finance. So if it's a large investment, he will make sure that there is a line of financing available. So it could be internally financed. It could be a working capital finance coming, a surplus coming from working capital release that can be used in the capital budget. So sources of finance are identified for the project, and then the progression is seen and monitored every month by the senior leadership team. But within during the month, the technical project manager and the treasury manager, they're working very closely as to what is coming in the next 1 week, in the next 1 month, in the next 3 months. So those kind of spend phasing is actually closely updated and monitored. And you're right, things can be delayed, things can be expedited, costs can change. Those kind of factors needs to be taken into account, and it's part of the good cash flow management.
Fantastic, sir. Fantastic. Okay. So now let us take some couple of important points. I think we already talk about AI and ESG. So what is the future trends of this capex budgeting process? How do you think that the new trend is it going to be changed? Like we don't do too much ROI calculations at the moment for the capability building kind of initiatives. Okay, so what is the future of capex budgeting? Yeah, so I think three of you can brief. Yeah. Alex.
Okay, let me start. I see not only in capex budgeting, I see AI as one of the key enablers in the future to improve the whole this process of creating and controlling, executing the capex. So it can help us a lot. So this is where I see the major improvement. Another thing, it's refining your KPIs. That is on the execution side. If you don't define right KPIs, right objectives, your periodic, let's say 3 months objective and the KPIs, you won't be able to see all the weak points during that process of execution, and your response will be late or inadequate. So improving that what people call OKR management, objectives and key results management, including KPIs, that, and I see a role of AI, huge role of AI in that. And then people on the other side, actually on the first place, people that change management, where AI can also help a lot with training, with personalized training. Now we have usually group training, but AI can personalize and create a training plan for each individual right quickly, about seconds, and then deliver that training, and also remove some resistance and barriers to change. That's how I see it in the future.
Yeah.
So,
So,
yeah.
yeah, Sandeep ji. Yeah, please.
So, what I see is actually, and what I experience is, in most of the times, how to avoid capex to begin with, right? So that's the trend actually we are continuing to see. And so how can I make it more agile, right? How can I make sure that my break even points are much lower, right?
Hmm.
So I think so Alex touched upon it, and Khalid also. If market fluctuates, how do I quickly move away from it, right? Having a cash reserve is one aspect of it, but offloading capex altogether to a sort of an opex model, right, where we can minimize capital expenditure, especially not it's not only about just the cash which is getting invested, but the whole organization has to align itself, right? And that takes a long amount of time in terms of the new expense, right? So that's an increasing trend, what I would say.
Mhm.
We are seeing, and we are seeing that in AI also, right, where the infrastructure as a whole has to be moved away, right? So the hyperscalers, actually, what we see in the Middle East especially is, in such a hot environment also, you have data centers coming up, right? And how will you avoid the capex altogether is one of the increasing trend. And then I think so probably we talked about earlier in terms of the execution also, right? How the PMO is set up, how the monitoring happens, and what the PMO is mostly now doing is relying more on predictive analysis, right? Saying that anticipate things in advance, right? And extending the life of an asset, which we probably talked about earlier in the discussion also. How do I extend the life of my current asset, right? And the fortunate part is, your data is allowing you to do that, right? Especially when it comes to physical assets, it's more to do with the science rather than a marketing forecast, right? You go and build a plan based on marketing forecast and things go haywire. But the way the plants operate in a manufacturing setup, right? Or
Mhm.
the transmission lines or distribution lines, which are they are much more reliable because they are governing the law of physics. Not, the bias is much more lower in that, compared to the any other data what we'll receive. So these are the few trends I see, using the technology as the backbone to accelerate, or to, probably divert capex altogether.
Fantastic. Sir, I think we have only 10 minutes left now in the discussion. So, would you like to recommend any KPIs for the capital capex budgeting? Khalid Saab, if you would like to give a take, any good KPIs who can do that, okay, and then followed by the key takeaways for the meeting we talk about, because we are running out. We have only 10 minutes left in this discussion. Yeah, Khalid.
Right. So essentially, for analyzing any major strategic project, it's financials alone are not the financial KPIs like NPV and IRR are not sufficient. So you have to create a weighted scorecard. It can be similar to balanced scorecard, but a weighted scorecard is whereby you are actually assigning weights to the strategic priorities. So, for example, if there is a entry into the new market, and strategically it's very important, and it's a long-term decision. So you will assign a weight accordingly. Maybe 60% is assigned to the market entry decision, and 40% maybe to the finance decision. So there is a weighted score. So there is a prioritization, and there could be several geographies where investment can be made. It could be India, it could be Indonesia, it could be Malaysia. So a project ranking and prioritization needs to take place, and that prioritization is actually with consensus based on the outlook again, market outlook, opportunity there, and then comes the financial. So it is very important, and also you take into account the risk. So by looking at various scenario analysis and coming up with the expected expected cash value coming from each scenario, and you assign a probability that what's the best case the probability, what's the base case. So those kind of parameters can be used, and there are several. But the most important one is actually a weighted scorecard.
Perfect. Perfect. So I think let us take a final round of discussion on the key takeaways round. So let us quickly discuss. So I think let me give you some maybe three or four key takeaways from my side. So one thing is what I have noticed is when you have a strategy projections. Okay, so you come with all marketing effort and all. So you have a strategic projections of your products like 3 to 5 years quantities what you're going to sell. Okay, so then you have like capacity planning. You do the rough cut capacity planning, how much you needed, what is the gap. So one thing which we have to notice make into consideration is you need to optimize capacities using any methodologies, any frameworks, so that you relieve, you get some additional capacity. You don't just go with the existing inefficient capacities for the planning. So you optimize them, and then also you consider like subcontracting. If there is a gap is only very small, just try to accommodate a subcontracting model kind of thing. If it is not, then you go with the expansion, very capital incentive expansion, so that you need to do it. The second thing is when you are doing a multiple capex and also some other initiatives, there are interlinkages between these. Okay, usually almost always in my experience, these interlinkages does not work properly. So you have to
Yeah.
have a holistic view for the strategy. So what is the sequence of things to be completed, and make sure that they deliver, because at the end of the day, if you complete them in a sequence, finally you get the value of strategy execution. Okay, that is very important, what I have experienced. Third thing is you have a capex capex plan, and there is a schedule, a project plan. Stick to it. Sticking to the capex completion is very essential, because the more you delay for any initiative, you are not only creating problem for that initiative, you are disturbing the whole plan of strategy. Okay, so you complete them. I have one example: the Kia plant in our district. It's only plant in India. Okay, they have completed before the deadline. Okay, so they have completed the big project, the plant 2 months before the deadline. So they were able to release this the cars on the day with 100% ready. So that is the reason it was a kickstart. So that is very important. If you complete them on time, then you get the value of your plan. Okay, so that is the final thing is, as Samir said, so include in the capital in the capex not only the value of that which is technology things and all, include the enablers, which could be change, it could be the little integrations, it could be the trainings, nothing related to the capex. Maybe the capex part which are influencing other things, you include them. Okay, people will not do that because these decisions are made in a separate session. Okay, so do them. These are the four key takeaways from my side. So yeah, please, Sandeep ji. Yeah.
Yeah, I think so. To ensure that the capex is strategically aligned, right? There is a series of questioning which has to happen at the strategic office, right, and the senior managements, right. So that's very important, right? Whether the spend which is happening, whether it is aligned to our strategic positioning, like I said, can we, what is the opportunity cost of this decision? Can we do away with it? You talked about subcontracting, right? Should we even go for capex or not? So these are the few things actually which are very important. And having a portfolio of capex, I think so probably we talked about during our discussion, saying that okay, how a portfolio approach will help. How much I spend in growth, how much I should spend in maintenance, how much I should spend in my risk management, and how much I should spend in the new initiatives, AI, ESG. So that's portfolio approach also would be another important point, I would say. So these are the few things I would definitely recommend all the leaders to evaluate.
Fantastic. So there is one question also from Alan. So maybe that could be the last question. Okay. So Khalid Tab, you can take up that answer, the question. An organizational issue, misalignment between strategy and financial budget is quite common. The challenges of alignment between two corporate level functions. Any views on having both functions reporting to one common senior executive?
Right. Thank you, Alan. Great question. And obviously, we see this kind of misalignment very often. And this is because of the silo thinking that the finance guy is only thinking about the finance KPIs. So it is to do with the corporate culture. So we have to create a collaborative, very coordinated work environment where people discuss openly strategy, and the strategy has to be an everyday affair. We should be talking strategy every day, not after 2 years or after 1 year, because it is strategy that drives the company's future performance. So if we are able to align finance and the business units on the investment requirement, then we should be using not we should be using a balanced uh, weighted average scorecard system to evaluate projects and not just purely financial. And things are changing now. Finance people are no longer finance people; they are business people. As we see great CFOs like Sanjeev and many others who are actually actively involved in the business process and business decision making. So I think we'll see a much better in future whereby the decision making is a combined decision making. It's a much more strategic decision making as opposed to only purely finance or only purely business decision. Thank you.
I hope this answered the question. Yeah. So, any final thoughts, Alex, before we wind up?
Yeah.
Yeah.
As I said, start with strategy, and the capex decision comes only and somewhere towards the end of strategy formulation process, because you have to answer all those questions: why, what I want to achieve, and then comes how, what I need to buy, what capability I need to acquire. Maybe I'll buy a whole company, purchase a company, not to build a new plant. So start with capex is just one choice in the strategy development process. And then the key owner of strategy, back to that question of the Alan Feld question, is a CEO. CEO must be the key owner of strategy. He must adopt that strategy. And if he or she, obviously, does that, then you won't have a problem of conflict between chief financial officer and chief strategy officer, because the chief executive officer above them is the key owner of strategy, and he will drive them. They will participate in the strategy development, as Khalid said, but the CEO is the one who is driving it. So that's from me.
Thank you.
Perfect, sir. Perfect. I think, yeah, that's a great discussion. We run out of time. Okay, so yeah, let me just take, we have to close the session now. Yeah, I take this as an opportunity to thank all the speakers and then participants. Thank you, Alan Fell. Thank you, Samir, and everybody who's active. Okay, so Fru Strategy has a module for the budgeting, so which has a very detailed capital expenditure budgeting model, so which includes the analysis part of NPV, IRR, and all those things, which is a schedule of payments, and then it has connected to the strategy through balance scorecard, strategic objectives kind of thing. So if anybody would like to try it, yeah, please let us know so that you can try it and you can use it in case if you want to try for some period of time. We don't have any problem. Okay. So I take this as an opportunity to thank organizers and everybody in the session. Wonderful session. I really learned a lot from three of you, Khalid Saab, Alex, and Sandeep. So a big thank you to all of you, and a wonderful session. We post this video very soon in the LinkedIn. It's already available in the YouTube. We share it. Any questions? Post the call. We would like to coordinate and set up a small discussion. We don't have any problem because it
Sure.
is so important topic. So thank you all. Thank you very much,
Thank you
and
so
have a
much.
great time.
Thank
Thank
you.
you.
Thank
Thank
you.
Thank
you.
you.
Thank you.